You've heard of exchange-traded funds. Perhaps you actually own ETFs themselves, but you're probably wondering, are these really the tools best suited to help me with my own retirement goals? Well, stay tuned to this week's episode of the Retirement Income Source, where it's all about the income. Welcome to the Retirement Income Source, where it's all about the income. I'm David Scranton, here with Sarah Samuels, of course. And today we're exploring the world of exchange-traded funds, aka ETFs, how they're similar to and different from mutual funds. And also, are they something that can help you towards your goals, or depending upon your situation, perhaps something that you'd be better off staying away from?
Yep. It's an extremely important topic, David. I'm excited to be here, of course, with you and with all of our listeners as we delve into ETFs and mutual funds, and most importantly, why they might not be the best tool for people to use in their retirement. But first,
or
Dave,
they might be.
Or they could be. We're going to cover that. But Dave, I don't know. I hope our listeners were able to catch you on Bloomberg earlier in the week talking about one of our sound income strategies ETFs known as Divvy.
Yeah, I'm sure all of our listeners, they stopped everything they were doing at 12:15 on Monday afternoon to tune into Bloomberg Television to watch that. I'm sure that's what happened.
Yeah, well, it was extremely informative. It was awesome hearing you explain the Divvy Fund and all of the inner workings of it.
No, it was fun too. It was nice. I love to do that. It was a great Monday kickoff to the week. And it was after a great weekend. Actually got to take a boat ride this weekend, even though it was only a high temperature of 70 degrees. Threw on a layer or two, and it was nice to go down the Intracoastal. It was a good thing.
How about you? A little chilly for a boat ride, but maybe not for our listeners that are outside of the Florida area. That's probably true. Sounds pretty nice for the end of February.
You can tell all the visitors, right, who come down here, they're the ones when it's 70 degrees, you're sitting by the pool, you're sitting on the beach, and all the residents have sweaters on and boots and everything else. But how was your weekend? How was your week?
It's been pretty good. It was an overall pretty busy week. And it was mostly it was exciting. The highlight of my week, Dave, I think, was listening to you on Bloomberg, because I was just pretty. Well, even though you're the boss here, I was pretty impressed by just the way you broke down the Divvy Fund in a way that people could understand it. But speaking of ETFs, Dave, and mutual funds, let's get more into our show topic and kind of cover what these investments are for listeners that maybe aren't familiar.
Well, where they're similar, Sarah, as you know, is that they're essentially pooled investments. They could be non-actively managed, or they could be actively managed. So they could be an index, for example, the S&P 500, where just the 500 of the largest companies out there, and it's not managed unless the stocks in the index change. You can have that in an ETF, you can have that in a mutual fund, or you can have it actively managed by a manager in an ETF or in a mutual fund. And the general advantages of these are twofold. Number one, if it's managed, you get professional management. So that's good if you're not a do-it-yourself investor, if you don't feel comfortable doing it yourself. But the second and biggest advantage is if you're a small investor, you can diversify cost effectively with a very little amount of money that you just might not be able to do if you're trying to diversify with individual securities.
Yep. Well, that is one of the benefits of investing in ETFs and mutual funds. But the question might be, how much do you really need to have a diversified portfolio outside of that? And our next question actually comes from Candace in Florida, and she's wondering exactly that, Dave. So how much money do I need to have a diversified portfolio in order to invest outside of mutual funds and ETFs?
Well, Candace, it really depends. And the answer's changed over the course of the years, because a lot of the trading fees and commissions have gone away now. So, for example, in the world of stocks, for the most part, you can cost effectively diversify with very, very little money. Remember, it was Robinhood that really got out there and started all the low cost trading. And now a lot of the big platforms that work with independent investment advisors like ourselves, Schwab, Fidelity, they have no commission charges, no ticket charges if you make trades. So you can have, $50,000 and cost effectively diversify. But the problem, Candace, comes in if you're retired or close to retirement. Now you don't want to have all your money sitting in stocks. You probably want to have some bonds involved. And with bonds, it becomes harder to cost effectively diversify. And a big part of the reason is because anything under, let's call it $5,000 per bond, means that you probably can't sell it. It's going to be hard to get out of it if you want to get out of it. And frankly, it's going to be more expensive and more difficult to buy. So as a result, in order to diversify, the best rule of thumb I like to lean on is $250,000. If you're younger and you're mostly in stocks, you can diversify with a lot less. But as you get closer to retirement, 250,000 is a number where if you start to integrating some bonds into a stock portfolio, you should be able to be fully diversified and do it cost effectively. So, Candace, I hope that helps.
And Candace, thank you so much for sending in your Ask Dave question. And if any of our listeners out there have a question that you would like to ask Dave, just send us an email to askdave@retirementincomesource.com. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton, and today we're talking about ETFs and mutual funds, what they are, what the differences are between them, and whether they might benefit you depending on where you are in your journey, if you're nearing retirement, if you're in retirement. So Dave, let's talk more about what are the main differences between mutual funds and ETFs?
You know, there's so many similarities that the similarities are greater than the differences, right? Because again, you have diversification with a small amount of money. You can have a static portfolio or actively managed portfolio. If you have actively managed, you can have an active manager. And you don't have to go to a financial advisor. You just have to pick the right funds or ETFs, and the manager in the fund or ETF will manage it. So those are some great similarities. But the differences. Mutual funds have been around much longer than exchange-traded funds. I believe, don't quote me on, I want to say 1924 was the first mutual fund that actually existed, and then they became much more regulated with the Act in 1940. And, you know, they have their benefits, they truly do, but there are some disadvantages to mutual funds. For example, you can't make trades in the middle of the day. So you can only buy or sell at the end of the day. And at the end of the day, they do what's called truing up, where they take the price of all the stocks at the close of the market and they average it together, a weighted average, and they figure out, okay, this is the price per share of this fund. And it's once a day at the end based upon the actual price of the stocks, right? Also, tax consequences. So if you're in a taxable account, mutual funds have tax consequences, not just the dividends that get distributed, but also any capital gains that are incurred. So, Sarah, as you know, even if you have a stock mutual fund that you just got in, but a little bit after you get into the fund, they sell a stock they've held for years and have a capital gain. That capital gain gets distributed to you, and you have to pay the tax on it.
That's right. Yep. Capital gains tax.
So that's a big. That's even though you're not selling the fund, they're just selling a stock in the fund. You have to pay the tax. So you have a little bit of inflexibility from the standpoint of when you can buy and when you can sell. You don't really know in the middle of the day what the fund is worth. Also, you have the tax issue. Fees can range anywhere from a non-managed fund to less than 0.1% to a managed fund where they could be as high as 2%. And sometimes they also have marketing fees in there. So, for example, is 12b-1 fees, right? Where what you're doing is you're paying for, if you have a Fidelity fund, you might be paying for the Fidelity advertisement on TV. And it's called a 12b-1 fee, which is a fancy name to say that all those television advertisements that they're doing to get new shareholders, which aren't helping you as a current shareholder, they're there to get new shareholders, those are being charged back to the fund. So again, they've been around a long time, but those are some of the disadvantages. So you're probably wondering how does that differ with ETFs, exchange-traded funds? Well, coming up, we're going to focus on that and the differences between the two just a bit more. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it's all about the income.
Welcome back to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton, and we are diving deep into the differences between ETFs and mutual funds. We're talking also about the similarities because they have a lot more in common than they have differently. Mostly, Dave, they're a pooled investment. There are some benefits associated. You can effectively diversify. You mentioned the magic number was $250,000 in order to diversify outside of mutual funds and ETFs. But there's a lot of benefits to investing in mutual funds, and there's a lot of differences too with ETFs. So we covered with mutual funds that you can only really trade at the end of the day, even though you can put the order in. During the day, it only trades at the end of the day, and you only know the true value then.
Right, so you put the order in midday, you're really not sure what you're going to get. If the price goes down and you're selling, you could get less.
Right, and you don't know the actual value. Plus, you mentioned that the tax issue with the capital gain. So let's talk about ETFs. What are some of the benefits with those versus mutual funds?
So with exchange traded funds, they can be traded during the day. So, and especially you wonder why recently, all these Bitcoin ETFs came out. Well, why don't they have a Bitcoin mutual fund? Why don't they go that route? Well, because it's so volatile that, if it goes up, $3 in a day, you might want to be able to time that. You don't want to be stuck at a price at the end of the day. You want to know what you're going to get. So one of the advantages is being able to be traded during the day. Another one is you get a lot more tax efficiency. That whole concept of distributed capital gains when something in a portfolio is sold at a gain. Within ETFs, most of that goes away, where you pay capital gains taxes primarily when you sell the ETF itself. So again, it puts the control of that taxable event back into the shareholders' hands. Also, if you are leveraging it, then let's say you have a margin account, right? Then you can actually have a margin against an ETF. You cannot have a margin against the mutual fund. In fact, most custodians won't even let you have a mutual fund in a margin account. So that creates an issue. So again, another advantage of ETFs. And in most cases, not all, but in most cases, the fees tend to be cheaper. Even for the actively managed exchange traded funds, the pressure is to push the fee down. I mean, Sarah, for example, our funds are actively managed and we pretty much focus on them. But because the pressure and everything, when we launched those, we felt like we need to keep the fees under 0.5%.
Right. And we talked about that actually last week, how those fees and the hidden fees that can stack up.
Whereas in a mutual fund,
funds.
we could take the same management style and charge 1%, 1.5% all day long. And the other thing with fees is that in an ETF, you don't have the 12B1 fees. You don't have those marketing fees we talked about.
So you're not subsidizing their television commercials.
That's right.
That's
nice.
Right.
That's right. So when I'm on Bloomberg, I have to get on there free, right? Because if I don't get on there free, we're paying for it because our customers aren't. And that's so there are lots of benefits to ETFs compared to mutual funds.
Right. Our listeners know they didn't sponsor that Bloomberg interview that you had. Let's get into our Ask Dave question. This concerns mutual funds. So our question comes from James out of New York. He says, Dave, most of my money is invested in my 401k, but I listen to your show and I know you're not a fan of mutual funds. I'm 50 years old and plan to retire in about 15 years or so. Can you explain why you're not a fan of mutual funds?
Well, James, I know we talked about the things so far in comparing them to exchange-traded funds, but those are mostly minor reasons I'm not a huge fan of mutual funds. And again, if you have under $250,000 and you want to cost-effectively diversify, then mutual funds are great, right? But as you get closer to retirement, here are some of the issues, and I want to break it down between stock funds and bond funds, right? So first of all, bond funds. People who are retired or close to retirement like bonds for part of their portfolio. Why? Because bonds have two important assurances. Number one, they assure you a fixed rate of interest, a fixed interest payment for the life of the bond to the bondholder, and they assure you that when that bond matures, you get the full face value back from the issuer, providing, of course, the issuer hasn't defaulted or gone bankrupt. So again, two important assurances that retirees and near retirees like when buying bonds. The problem is if you buy bond mutual funds, both those guarantees go off the table. They do not exist. Your income can and will fluctuate, and there is no fixed maturity date where you're assured to get back any amount of principal. So as a result, bond funds have more risk than a diversified portfolio of individual bonds. In fact, the definition of a bond fund is actually the stock of a company that owns bonds. So it even sounds riskier. But that's not the end of it. Stock funds also have an issue. What's that? Well, most stock fund managers don't invest for income for dividends. They invest for total return, primarily growth, irrespective of how much comes from dividends. And if you're retired or close to retirement, you want to start focusing on an income first, growth second mindset. And most stock fund managers simply don't do that. Why? Because they're afraid to deviate from the index against which their performance is compared. Why? Because they know they might beat the index a few years and they might underperform the index a few years. And they know that people have short memories. You underperform for a year or two, you're going to lose assets, people are going to start liquidating the fund, and that fund manager is likely to lose his or her job. So that's why it's not that I'm against mutual funds, it's that as you get closer to retirement, if you've accumulated more than $250,000, you could usually do better with diversified portfolios of individual securities and not mutual funds. I hope that helps.
James, thank you so much for sending in your Ask Dave question. And if any of our listeners or our YouTube viewers out there have a retirement question that you would like to ask Dave, all you have to do is email us at askdave@retirementincomesource. That's SOURCE.com, and you might hear your question answered on a future show. Thanks for listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we are demystifying ETFs and mutual funds. We've talked a lot about the similarities between the two, as well as some of the big differences. And Dave, you just clarified for one of our listeners, and James, thank you for listening to our show, but you clarified, that there is a place for mutual funds. If you have less than $250,000, if you're maybe in that growth phase, like I'm invested in a lot of mutual funds, but it makes more sense for my stage of life. But you mentioned they're a problem really on both the stock and the bond side. Can we cover that a little bit more in depth and explain to our listeners why?
Sure. For those folks especially that are retired or within 10 years of retirement, because you always talk about that equation, TR equals I plus G, right? Total return equals income plus growth. And during your stage of life, the accumulation years, Sarah, all you care about is getting total return. You don't care where it comes from, especially if it's in a tax-deferred account like your 401k. If it comes from the I, the income, or the G, the growth, doesn't matter. You just want to make money on your money. But when you get close to retirement, you realize, wait a minute, most of this money sitting here isn't going to be cashed out in a lump sum so I can go buy a giant RV. Some may, right? But most of it is there to generate retirement income to replace your paycheck. And therefore, all of a sudden, how that return divides becomes more important than the actual return itself. An income first, growth second mindset. And again, with mutual funds, you lose the assurances of bonds when you buy a bond fund. And as a result, you own a stock of a company that owns bonds. You don't own the bonds. And with stock funds, even though there may not be stock funds compared to stocks, might not be as bad as bond funds compared to bonds for a retiree or near retiree, but still they have disadvantages. You're really hard pressed to find stock funds that pay a high dividend yield, or even in the ETF world. I mean, part of the reason we created our two ETFs is because I couldn't find ETFs out there that did for retirees what we do in managing individual securities. So we found a need in the market and went out and created them.
Right. Well, you mentioned a few minutes earlier that's the big problem, is that a lot of stocks don't provide those dividends, and that's what people really need. That's the income part of the equation when they're in retirement.
Yeah, the stock funds don't pay the dividends most of the time because, again, fund managers are really trying not to do poorly. They don't want to underperform their index. And you see, they have a drag. They have a lot against them. First of all, they've got to have the fee. So they've got to earn more than the index by the amount of the fee so they can match their index to which they're compared. But moreover, there's a drag in a big account like a mutual fund. For those big mutual funds, Sarah, they have so much money that if they want to buy a new holding, as they buy more and more of that stock, they actually can drive up the price of the stock because they're buying so much of it in a given day or a given week. So they're paying more for it in many cases than an average investor. Conversely, when they go to sell, they're selling so much of it, they might drive down the price of the stock, which means now they're getting a lower sales price than the average investor. So mutual funds have to do maybe 3% better than an index just to match the index. And that's hard to do. And that's why they're so afraid to deviate too far from the index. And that's unfortunate for income investors.
Right, absolutely. They don't want to end up on the unemployment line, but you end up paying the price. So maybe you're out there and you're listening and you've heard, hey, my financial advisor has been promoting ETFs. He seems to want to get me in ETFs, and you're wondering why. Well, we're going to ask Dave. Stand by for Dave's answer. I'm Sarah Samuels here with Dave Scranton, and you're listening to the Retirement Income Source, where it's all about the income. Thanks for listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and today we've been talking about ETFs versus mutual funds. So we've been talking about the benefits, the similarities, the differences, and some of the main things between the two of them, and why people need to, what they really need to know if they want to invest in them or if they are currently invested in them, depending on where they are in their retirement journey. So Dave, just a few minutes ago, you mentioned this concept of drag. It's a hidden fee. It's not something that someone's going to see in their fee list for mutual funds, but it happens when a fund buys or sells large portions of the stock, and it can drive the price up or down. Do ETFs have a similar problem?
Oftentimes they do. They could, for sure. But I think that's a great point that you made, and I'm glad you did, because it truly is an invisible fee. You know, you have a management fee, you have an administrative fee. Those are visible, right? You have a 12B1 fee, even though it's not doing you any good, it's still visible, right?
You know about it.
A sales load is visible, right? But this drag fee is invisible, and it varies from fund to fund, and it's really hard to predict. But I will tell you, the bigger funds have a disadvantage because they've got more of each particular holding, right? So how does that apply to exchange-traded funds? Well, if they're passively managed, which, by the way, were the initial funds, right? The initial funds in the 90s were SPY. SPY is the S&P 500. It's an index. It's not managed. So you don't really have drag fees in that index, except every once in a while when the index gets rebalanced. Then you certainly do have drag fees. The other one that came out in the 90s was the QQQ, the NASDAQ, right? And again, that's a non-managed index. So again, the only drag fees they have is when a stock comes out of the index, gets replaced by another stock, then it could have an effect. But actively managed ETFs can have the very same problem as the mutual funds. They want to buy or sell a big holding, and it becomes an issue. But here's the benefit. At least at this stage in the ETF world, most of the biggest ETFs are not managed. They're passive funds, whereas almost all mutual funds are actively managed. So you get some, should I say, ginormous mutual funds out there.
Hey, it's in the dictionary.
That's right, that actively manage and have this issue. Most of the actively managed ETFs are smaller funds that don't have as much of the issue because they're not trying to buy or unload as big of a dollar amount of any particular stock. So although, yes, in the textbook it has the same issue, real world, it's much less of an issue.
Yep. Now, the sound income strategies ETFs, both divvy and fixed, those are actively managed.
Those are actively managed. That's right. Because again, we wanted to mimic what we do for our clients with individual holdings, but be able to have other advisors. You know, a lot of advisors like using ETFs. They don't want to use individual securities. So for me, I want to say, hey, let other advisors be able to do what we do. And have access to that, even if they don't do individual securities.
Yep. Well, that kind of leads us to our Ask Dave question, actually. So we have a question from Jane in Illinois. She says, it seems most financial advisors tend to be favoring ETFs over mutual funds and individual securities, too. Why is that?
Is it Jane or Jean?
Jane.
Jane.
Sorry, Jane.
Okay. Jane, it's one word. It begins with an L, and it ends with a Y. The word is lazy. Unfortunately, most financial advisors today have fallen prey to what a good friend of mine who's a financial advisor calls the disease of ease. That financial advisors like a business model that doesn't require a lot of work on their part. And, you know, they can put together a portfolio of a half dozen different ETFs in a blink of a second. But to put together a diversified portfolio of individual securities, they'd have probably between 30 and 60 different securities. That takes a lot more work and, frankly, a ton of research. So, unfortunately, most advisors have gotten to the point where they're not really managing money anymore. They're just asset gatherers. And as a result, they're outsourcing the management to these exchange-traded funds. And yes, most advisors like ETFs better than mutual funds these days for all the reasons we talked about at the beginning of the show. But the fact that most advisors are suffering from this disease of ease and are not managing the money and are being a little bit lazier, as I said, is that 100% a bad thing, Jane? Well, it's really not. And I'll tell you why. If you have an independent financial advisor, let's say that's one advisor with 2, 3, 4 support staff, frankly, that person may not have the bandwidth to do the money management, whether they don't understand maybe the technicalities of how to buy individual stocks and bonds and do the research, but they understand macro portfolio management, or they don't have the time, right? If they're meeting with you, doing client reviews to make sure you're on goal with your targets and everything, then they can't be watching the ticker tape all day making trades. So for small operations, it's probably better that they know their limitations and they're willing to outsource the management to ETF managers. Okay? But I think even in the smaller advisor independent world, I think the smartest advisors are the ones that know enough to outsource it to other managers so that they can have the benefits of both worlds. They can still not have to do the day-to-day management, and they can still meet with you and spend time making sure you're on target for your goals, but go out to a professional money manager, even if it means giving up some of their fee, some of their revenue, to have a money manager manage a diversified portfolio of individual securities for their clients that are retired or reaching retirement. They may make a little bit less money if they do that, but I think it's the end result is better for you than the advisor putting you in a portfolio of mutual funds or exchange-traded funds.
Well, Jane, I hope that helps answer your question. And thank you so much for sending in your Ask Dave email. And if any of our listeners out there have a retirement question, maybe you have a question about ETFs or mutual funds even, and you would like Dave to answer it, all you have to do is email us at askdave@retirementincomesource.com. And thank you for spending your time here with us on the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we have been answering your questions, probably your most common questions when it comes to ETFs and mutual funds. So, Dave, you covered a little bit some of the benefits of them, some of the drawbacks, as well as some of the major differences between mutual funds and ETFs. And you just answered a question from Jane in Illinois, who said she feels like her advisor is favoring ETFs, and there's a lot of reasons for that.
Well, yeah, and it's better for an advisor who doesn't have the bandwidth, whether it's knowledge bandwidth, financial bandwidth, or time bandwidth, to try to get in there and manage a diversified portfolio of individual securities and to screw it all up. It's better for them to outsource it to a fund manager or ETF manager. The problem is that now there's a hidden fee. So now if that advisor is charging 1% to shuffle around the percentages of the half dozen ETFs that he might have a client in, or you do some rebalancing, then if there's a hidden fee in that fund or ETF, that it's just easier for the advisor to sell the client on that because the visible fee is only 1%. Where if you hire an outside money manager to manage a diversified portfolio of individual securities, let's say that money manager charges 0.5%. Well, now that's going to be visible. So now you're saying, ooh, the advisor's charging me 1, the manager's charging me 1.5. What is this? And that's why I made the comment that, to me, the best independent advisors are the ones who are humble enough that know their limitations. They're not going to try to do it on their own, but they're willing to give up some of their fee. So, for example, if they are charging 1%, that's it. They might pay the manager out of that 1%. So they make a little bit less, but they're doing a good job for the client, and the client's not getting overcharged. And sometimes in business, if you want to grow your business long-term and have the most successful business, it's not about making as much money as you can up front. It's about doing what's right for the long run. And most of the time, you'll make more money in the long run as that business owner than the one who tries to get it all up front.
Absolutely. And if you're looking for a specialist out there, someone that can help you with income as you're nearing retirement, or maybe you're early on in retirement, go and check out our website. It's retirementincomesource.com. We actually have a map on there. You can select your state and find income specialists in your area that can help you with all of these things. They can help you figure out what you need to invest in. And I can tell you, it's not mutual funds. It's not bond funds, right, Dave?
Well, if you're in or close to retirement, have over $250,000, in most cases it's not. And the reality is, maybe it's just a philosophical thing for me, Sarah, but I like transparency in relationships, right? I want to know if I'm dealing with an attorney, I don't want to pay hourly. I want to know how much is it going to cost to help me with this particular thing. I want that transparency up front. And most people would be willing to pay more if they know what it's going to be. And the problem with mutual funds and ETFs is they're not as transparent. And so, again, when there's a portfolio of individual securities being managed, all the fees are transparent. People know what they have. They know what they're getting. And we'll talk about a little later on the show, Sarah, that also the holdings that are in there are more transparent. Sometimes in a mutual fund or ETF, those holdings can be opaque.
Yeah. well, people really appreciate that transparency. So we'll talk a little bit more about that. I'm Sarah Samuels here with Dave Scranton, and you're listening to the Retirement Income Source, where it's all about the income.
Welcome back to the Retirement Income Source, where it's all about the income. I'm David Scranton, of course, here with the very lovely Sarah Samuels. And today we're talking about ETFs, exchange-traded funds. And specifically for those of you who are retired or approaching retirement. And so far we've covered that in many cases ETFs have more advantages than their older siblings, the mutual funds, but still not as many advantages as a diversified portfolio of individual securities if you're retired or within 10 years of retirement and you have at least $250,000 to invest. And I know, Sarah, we just were talking a little bit about the visibility, the fact that ETFs in mutual funds can be opaque. When it comes to fees, you actually have to look them up to find out what the fees are. Whereas if you have a manager, even if the manager outsources to a sub-manager, you know what all the fees are. You see them taken out of your account every quarter, so it's very, very visible.
Right. And people appreciate that transparency. They want to know where their money's going.
That's right. That's right. You want to know what you're paying for. Yeah. And the reality is that same is true with the holdings. You know, in actively managed funds, mutual funds and ETFs, there are some games played with the holdings, and typically they only publish the holdings once a quarter. So in the middle of the quarter, you never really know what's in the fund. And although it's not legal for them to do that, it's really hard to, what I'm about to say, it's really hard to enforce. But what a lot of funds will do is, if they have some ugly holdings in there that maybe took a big hit during a quarter, they may not want to show those holdings at the end of the quarter when they publish what's in there. So they might sell them, get out of them, and replace them with some better looking things. And then as soon as the quarter ends, the day ends, then they might go back and put in those things that just got beaten up that look ugly because they didn't really want to sell when they were low.
So that could cause a bit of a transparency issue right there, though.
Well, it's called window dressing, right? Yeah. So it's not even that, oh, gee, you just happen not to know during the quarter all the holdings in your fund, your ETF. But the reality is that sometimes it's done intentionally to mislead people because they want to look good. And if you see the 3 stocks in there that just hit the media over the last month, that they were dogs, and they happen to be in your portfolio, you're going to say, what is this manager doing, right?
Yep, you're going to lose faith.
That's right. So again, that's the problem there. But if you're in a diversified portfolio of individual securities, now you know what's in there. They're in there. They can't hide. There's no place to hide when it comes to the fees or the holdings. And if there's something in there that just got beaten up, well, guess what? You're going to see it as a client. And there might be, doesn't mean it's a bad thing. It doesn't mean the investment manager made a bad decision with it. But I'd rather have our listeners know what's going on than have some advisor put the blindfolds on them.
Yep. Well, let's get into our Ask Dave question. And I think this might answer some of our listeners' question out there. They might be wondering to themselves, just like Frank in Wisconsin, who's asking, why don't more financial advisors diversify their clients using these individual securities?
Well, Frank, it goes down to that bandwidth issue. So first of all, hiring an outside manager, costs extra money. And those costs are, as I mentioned before, are transparent. So now maybe the fund manager or the actual advisor has to show a much bigger visible fee than he or she wants to, or maybe pay some of that fee out of his or her own pocket for the sub-manager, and then as a result not make as much. That's part of it. Right? But the other part of it is a big reason why they don't do it themselves, and it's because it's really a different skill set. If you think about it, a financial advisor is there to look at your goals and to help you accomplish what you want. It's a lot of macro thinking, macro allocation planning, and that's one skill set. It's another skill set to be so micro that you're getting in there and analyzing individual bonds and analyzing individual stocks and figuring out what you think is low so you can buy it and what's high so you could sell it. Those are two different functions. The latter is a much more analytical function where you're sitting in front of the computer all day, you're reading research reports, and you're trying to make heads or tails of, hey, is this a good buy? Is this something I should sell? What is this really? Whereas the former is more about the relationship with you. a true financial advisor, even a certified financial planner like myself, the whole idea is to say, hey, okay, how do I build a plan that helps you with your goals? And some of it might be investments, but some of it might be tax related, estate planning related, and lots of other factors, insurance related, right? So again, if I'm busy working on those other things for you and talking to you and going over your accounts with you, I can't possibly be sitting in front of the computer doing analytical work. So it creates a real bandwidth problem. It's like you can have accountants, and some accountants are CPAs that work with individuals. Some accountants are corporate accountants. Yes, they're both accountants, but they do totally different things. And the same thing is often true here. So I hope that helps answer that part of the question.
Well, Frank, thank you so much for sending in your question for Dave to answer. And if you have a question that you would like to ask Dave, and maybe you'll hear an answer on a future show, all you have to do is email us at askdave@retirementincomesource. That's SOURCE.com. Thank you for spending your time here with us on the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we've been covering ETFs versus mutual funds, some of the similarities, the differences, some of the consequences of investing in both. And Dave, you just answered a really good question about why aren't more financial advisors diversifying their clients among individual securities. So you mentioned it could be because maybe they're a little greedy, maybe they don't want to pay a fee to the manager, but you also touched on something I think is important for our listeners to understand, which is that it is a different skill set. The financial advisor that's helped you hopefully grow your money during your working years is probably not the financial advisor that you're going to need once you hit those nearing retirement years. You're going to need to transition your mindset.
And moreover, the person who's doing that income work for you in the macro plan, most likely doesn't have the knowledge to go deep and analyze individual stocks and individual bonds, and moreover, doesn't have the bandwidth in terms of time, and many times doesn't have the bandwidth in terms of money. We always talk about how, in our trading department, I don't know how many Bloomberg terminals we've invested in, but, to do it the right way, you're paying $25,000, $30,000 per terminal. And so some advisors, whether it's financial bandwidth, whether it's time bandwidth, whether it's knowledge, they can't simply do both. Conversely, I know a lot of portfolio managers who are really good detailed people, who are really good at the analytics, that if you're so detail oriented, you're in front of the computer doing that kind of analysis all day, you're probably not very good with people, which means, when you're trying to talk to an advisor about your goals and concerns, that person's not going to make you feel very comfortable because they're more of a numbers person, more of an analytical person. So they truly are, in many cases, different skill sets. I'm kind of a weird duck because I've done both.
You have both. You have many talents, Dave.
But I gravitate toward the people side. I gravitate toward the certified financial planner side rather than the chartered financial analyst side. So I've done it. I've sat in front of the computer. I've done the analytical work, but it stresses me out. I don't love it. I'd much rather sit and help people realize their goals and dreams in retirement. That's what's fun.
Well, part of it too, Dave, is the inside baseball knowledge, right? The average person doesn't really know what's going on with a stock or with a bond, with some of these investments. Whereas if you are working with a team that can actively manage them, it's a lot. You have more control.
And not to mention the fact, but even if you have managers, the person who's managing your stock portfolio probably shouldn't be the same person managing your bond portfolio. Those are different skill sets too. Right. Even though they're analytical and they're detailed, if you think about it, it's like an offensive and a defensive coordinator in football, right?
They're two different jobs.
Yeah, offensive coordinators make crappy defensive coordinators and vice versa because they have a different mindset. And you have to have a different mindset. So as you get within 10 years of retirement and you're no longer all stocks and you have some stocks and some bonds, not only is your financial planner, your financial advisor probably not suited to do the analytical portfolio management, but really you need a couple different people, which means that advisor need to be big enough. If they're not going to outsource it, they need to be big enough to go out and hire their own portfolio manager on the fixed income side, their own portfolio manager on the stock side. And now you're talking about paying out huge salaries, huge technology costs, research costs, and it's just untenable for most financial advisors, no matter how successful they are financially.
Yeah. Well, it seems like most of the tools that people are used to investing in, the things that they feel most comfortable with, because that's what they've invested in most of their lives, the growth stage of their lives, they feel like it's difficult to transition, to get out of that mindset and to transition into more of those income-based, income-first methods.
And what's interesting, and that's an excellent point, I'm glad you squeezed that in here before we wrap up, because the reality is that people are used to mutual funds, so they're like your whoopee, they're like your comfort blanket. You feel good.
Your pacifier.
And going from mutual funds to ETFs is like, oh, that's easy.
Yep.
It's kind of like a better mutual fund, right? But you start talking about individual securities, and a lot of average investors, they pucker up a little bit because they're not used to that. So they just have to listen to the show more often, I guess, and continue to get educated, as the smart folks are that are listening to us today, about why those mutual funds and ETFs may no longer make sense in retirement.
Yep. And we hope the show helped you. And if you'd like to send it to your friends and family, all you have to do is go to retirementincomesourceradioshow.com, and all of our shows are there.
And most importantly, we hope that you join us right here on the Retirement Income Source. And next week, same time, same station. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it's all about the income.